Can I tell you a secret? HMRC can make even a car like this far cheaper than you think. But many business owners choose the wrong setup and end up paying thousands they never needed to pay. That's why in this video I'll show you the tax rules for company cars and which type of vehicle helps you save the most tax, especially after the 2025 autumn budget. To start, I'm going to show you the rules that makes one car cost almost nothing in tax and another that costs a fortune. Most directors think the car itself is the expensive part, but actually it's not. The tax rule behind the car is what actually drains your bank account. Let me show you.
This is Dave. He's a business owner and today he's choosing his next company car. On one side, he's got this Porsche Panamera. On the other side, he's got this Porsche Taycan. Now, Dave was seconds away from buying the Panamera, but he decided to call his accountant, just in case. 5 minutes later, Dave found out the Panamera would cost him over £10,000 in personal tax every year, and the Taycan would cost him almost nothing.
But before we go any further, you need to understand what actually triggers this taxable benefit, also known as benefit in kind. When a company buys a vehicle, it becomes a company asset. But if the car is also available for personal use, it triggers the so-called benefit in kind. And HMRC focuses on availability, not on actual use. If the car is parked at your house and you can drive it at any time, that's enough for them to tax you. There are strict conditions you can meet if you want to avoid benefit in kind, but to be honest, they don't apply to most directors. I'll leave the rules in the description if you want to see for yourself, but they're very strict. So, how is the benefit in kind actually calculated? Well, HMRC uses a simple formula. The list price of the car multiplied by CO2 emission percentage equals your taxable amount. Here's what both parts of the formula really mean. The list price, or the P11D value, is not what you paid for the car, or even the second-hand price. It's the official showroom price when the car was brand new, including VAT and all the extras. So even if you buy a 2-year-old car worth £30,000, but its original list price was £50,000, HMRC will use the higher figure. You can check the exact list price of a car by googling the model and its P11D value, or using an online calculator like the one in the description below. The percentage, on the other hand, comes from this CO2 emission table. The cleaner the car, the lower the percentage, and the smaller the tax bill you have to pay. You can find the emission of your car from your V5C logbook or using a government online tool that I left in the description below. But one thing most directors forget is that the company also pays tax on your car. On top of your personal benefit in kind, the company pays Class 1A national insurance, which currently is 15% of the benefit. So before you even think about a new car, you need to check the following two numbers. First, the list price using Google or an online calculator, and second, the CO2 emission from your V5C or the government online tool. And now that you understand the rule that decides your entire tax bill, let's walk through the worst and best setups with real cars you will recognize. Let's say you're deciding between this BMW diesel with 130 grams of CO2 emissions and his electric vehicle brother, the BMW i4. The benefit in kind table says the diesel option should be 32%, but HMRC will bump it to 36% because they're adding 4% diesel surcharge unless the car is RDE2 compliant. Assuming you're a 40% taxpayer, this car will cost you almost $6,500 every year just to drive it around. On top of that, you need to pay Class 1A national insurance and the corporation tax relief will be minimal. That makes diesel cars the most tax inefficient option for a company car. So what if you decided to go with the electric brother instead? Well, the BMW i4 is fully electric, which means the benefit in kind is 3% flat rate as for all EVs. Assuming you're a 40% taxpayer, you will pay only £720 as a taxable benefit, plus a tiny amount of Class 1A national insurance contributions. On top of that, you can write off the entire cost of the vehicle against your corporation profits thanks to the first year allowance. On top of that, the government confirmed that they're extending the electric car grant until the tax year 2029-2030, which allows you to get up to £3,750 off eligible EV models. There is a fantastic blog post from Carwow that gives more detail on which vehicles qualify. The government also increased the threshold of the EV luxury tax from 40,000 to 50,000, which enables a much bigger proportion of new electric cars to be exempt from the expensive car supplement. On the other hand though, driving an EV will be getting slightly more expensive in the next few years. The flat 3% benefit in kind rate will be increasing by 1% in the next 3 years until it reaches 5% in 2027-2028 tax year. That will make the size of your taxable benefit slightly bigger, but it will still be much lower than the other car options. Additionally, the budget confirmed the introduction of a new pay-per-mile road tax for EV and hybrid vehicle drivers starting from April 2028, which will add approximately £240 additional cost per year to run an electric vehicle. But let's say you're not ready to switch to fully electric yet. Maybe you want to test the waters with a good hybrid option. Let's compare this Petrol MG and their plug-in hybrid model. Petrol cars don't get hit with the same 4% surcharge as diesel, but the emission on this MG model is so high that you're going to pay the full 37% benefit in kind rate anyway. If you're a 40% taxpayer, it will cost you $3,500 in taxable benefit to drive this car before you even consider the Class 1A national insurance. On the other hand, the taxable benefit on hybrid or PHEVs depends on their CO2 emissions as well as their electric mileage range. The longer the range, the lower the percentage. On this particular model, the mileage range is only 32 miles, which is towards the lower end of the spectrum, but the emissions are still pretty low. The annual taxable benefit for this car comes to 1.6k, which is less than half of what you'd pay for the petrol option. Yes, you pay a bit more for the hybrid car, but the long-term savings should hopefully make it a better option. But let's say you carry a lot of equipment. Maybe you work in construction, surveying or photography, and you need a vehicle that can transport different loads. If that's the case, look no further than electric vans. Currently, they enjoy 0% benefit in kind, which means that even if you drive it personally, you don't pay any tax to the taxman. It's one of the rare gems in the tax code, so make sure you consider whether you need one before they roll back this benefit too. Additionally, they escape the pay-per-mile road tax I mentioned above, so that makes it even a better option. So let's see what that means for you in real life by comparing the Ford Transit Custom, both the diesel version and the fully electric one. You already know that diesel cars are the most tax inefficient and they have very high emissions, which places them at the bottom of the emission table. The annual cost for this one in terms of taxable benefit is astronomical, a whopping £7,000 a year and another 2.6k in Class 1A NICs. On the other hand, the electric van feels almost like an illegal cheat code. You pay £0 benefit in kind, which means that even if you drive it personally, you don't pay anything to the taxman. And since it's fully electric, you can write off the entire cost against your corporation tax profits. But whatever van you choose, just make sure the HMRC recognizes the vehicle as a van too, otherwise you'll miss out on tax savings and you get yourself in trouble. I've left their guidance in the description below for what they decide a van is. So if you're thinking about a new car, use this simple decision tree to decide what's best for you. If you carry equipment or tools, electric van is the option for you. If no, you need to ask yourself, do I want maximum tax saving? If yes, go with an electric car. But if EV doesn't work, at least you have the option to pick a hybrid car with a good electric mileage range. And then finally, if you're not worried about tax savings, go with petrol or diesel car as a last resort and enjoy the driving experience. But even if you choose the perfect car on paper, if you claim the wrong costs or allowances, you can still lose thousands or risk penalties. So let me show you exactly how the running cost rules work and how to pick the setup that actually keeps money in your pocket. Many people think they understand how company cars work until they realize how confusing all those rules and allowances actually are. Let me break down how running cost rules work in simple English. When you use your personal car for business, the company can pay you 45p per mile for the first 10,000 miles and then 25p per mile after that. This is called the mileage allowance, and it's supposed to cover all running and maintenance costs for the vehicle. It's simple, clean, and all you need to do is keep a detailed mileage log. But the moment the company owns the car, you can't use these rates anymore. Your company needs to claim the actual costs for all vehicle-related expenses such as fuel or charging, insurance, servicing, tires, repairs, etc. But most directors never realize how different the two systems are and they mix them up, which kills their tax efficiency. Now you know how to choose the right company car and avoid the traps that cost directors thousands. But there is another silent tax killer most directors still don't fully understand: the VAT. So watch this video next, where I show you how the VAT system works and how to save thousands by making it work for your business.